Okay, so I love multifamily deals, and we're seeing some distress in the market. There's one thing though that you can do as an investor, as an operator to protect yourself from a lot of pain. And I think one of the biggest things you can do is to do value add deals. My name is Bronson Hill. I'm the CEO of Bronson Equity. We've got about 200 million in multifamily assets, such as the one behind me here. We also do other alternative assets. But today we're going to jump into why I only really focus on value add deals and really what is a value add deal, what is a deal that makes sense, and why does it provide some safety for you? Because again, as an investor, Warren Buffett talks about rule number one is don't lose money, and rule number two is don't forget about rule number one. So we're going to jump into that, go over in 3 easy steps. You're going to love it. Got a good quote for you at the end. Stick around. All right, so quick disclaimer, I am not an investment advisor anymore. I'm not your investment advisor, so get your own independent advice. These are just my opinions. So really, when it comes to a value add deal, right? What is a value add deal actually really? Like, what is that? And so I want to give you an example. You can see this picture here. This is one of the properties we've done in Jacksonville recently. $1,000 rents here. They go up to $1,400-1,500 after a renovation. So we've seen that that's possible to be able to do that, and it gives you this upside, right? If you're doing something that does not have that type of upside, and every deal looks like a value add. I've even found some deals that look like they're value add, and then you look in and you're like, I don't know if those rents are actually really solid. But if you know that the rents that you are providing or the projections that you're having, you're going to be able to get to where you want to go, then that is really awesome, right? Because you're able to see the upside in rents that you want. So, there's this saying by Warren Buffett, it's said by other people too, but he says, the 3 most important words in investing are margin of safety. And what does that mean? It means that, if things don't go really well, are you still prepared to weather that? A lot of times we think, I look at some projections where they're only best case scenarios. You can see this example. This came out recently, 3,200 units in Houston, Texas, $200 million portfolio. These guys basically went bust. And why did it happen? I think part of it was because they were not conservative on their projections, right? So you can see on this, somebody sent this to me, but this is their investment opportunity. You can see closing soon, these apartments in Houston, 22% IRR and 30% average annual returns. These are very, very high returns. And it just makes me wonder. I find a lot of sophisticated investors, when they see something like this, they'll back away because they'll say, this seems like a best case scenario, right? And you really want operators that are very conservative, that really look at things, and we'll get into that in a minute, of what does that actually look like. So, really, where's the buffer? Where's the margin if things don't go according to plan? Is there a way that you're still going to be okay? So this is the reason why at Bronson Equity, we don't do Class A deals. What is a Class A apartment deal? It means typically a building that's brand new, built within the last 10 years. There's really no value to add. If you just built a building, you could add a pool and add a dog park, but that's not really adding much value, right? It's not really going to increase rents really much at all. So typically we're buying stuff that's 30, 40 years old, sometimes even older, and we're renovating and bringing it up to make it nicer, and we're buying in markets that are growing. So this is why I really have felt, and I've been saying this for a while, that Class A deals, especially if it was syndication, are some of the more higher risk deals. And I've seen some advertised online where it's like, here's this awesome, amazing apartment that's got a pool and a spa and a sauna. And it's like, I'm thinking, well, the investor is not going to be living there, right? So really the bread and butter where you do very well is these B and C class workforce housing apartments where they're not, Class D is the roughest area. You're not in Class D, you're not in a rough area, but you're in a working class neighborhood, right? And you're able to add this value to really see a lot of upside. So, there is something I will say about Class A deals with REITs, which are real estate investment trusts. These are publicly traded companies, basically, that own all this brand new real estate, and they have a different model. So if you're invested in REITs, I'm not a big fan of REITs for other reasons. I could get it. I have some videos about that as well. But REITs as well, they're able to go to the market and raise more money. So they put 50% down, so they have less leverage. But if they need money, they can just go raise more money from the public markets. Syndication, it's much, much tougher to do that. So I think if you're in a Class A syndication, I think there's reason, depending on what market you're in, to be a little concerned about that. So that's my opinion. I'd love to hear in the comments if you agree, or if you disagree, stick that in there. But really the question comes is, how do we build more margin in our deals. How do you do that as a passive investor? How do you find deals that have this margin of safety that's like, hey, even if things don't go the way we want, we're still going to do fine, right? We're either going to do okay or we're going to do great. Well, it comes down to conservative underwriting. I gave the example before of this group in Houston that you just look at the numbers and you're like, it just doesn't look that conservative, right? We'll find instead of having, for some of our deals, instead of having an 18% or higher projected average annual return, what if we say it's 14% or something, and then we say, but here's these additional upside ideas that we didn't even put in the numbers, right? So then as somebody who's a concerned investor and be like, oh, okay, well, it seems like that's a good idea. So some things you can do, to look for that is, really what is the conservative upside? It's not that you're uber conservative, because if you're too conservative, and I've seen this before, people just don't want to do a deal unless it's the perfect deal. And if you do that, you're never going to get there. But I think it's kind of a happy medium between best case scenario and uber conservative. There's kind of a space there. This is kind of real world, right? This is actually the way we think this is going to work. Some things can go wrong, some things can go right, but this is what we're looking at. So today, what does it look like to have a conservative deal? Well, I mentioned the example of rents going from $1,000 to $1,400 or $1,500. That's called forced appreciation, right? You have market appreciation, which is the market will just go up by, I think we had market appreciation of, 20% or 10%, huge market appreciation last year, 2022, 2021, big market appreciation. But, you can't control what that's going to do. You can't control necessarily how much the market is going to increase, but forced appreciation, meaning we see right now in our renovated units, they're getting $1,400 or $1,500. And right now we're getting $1,000 because these are non-renovated units. If we put in the $6,000, we're going to be able to see the upside and force the appreciation ourselves, right? So it's much, much safer because it's something that we have control over. We don't have control over the market, but we do have control over what's happening there. So forced appreciation is great. That exists in value add deals. It does not exist in value add deals. I mentioned the real world scenario. Make sure that you're looking at real world scenarios, not uber conservative, not overly aggressive. Look at something that's stress tested. So what happens again if things don't go as well? What happens if you don't perform on the deal? There's delays. What happens? Do we have enough cash reserves? What happens if the metrics when we're looking to sell are not as favorable? And this really comes down to higher interest rates. What if interest rates are higher? What if valuations are lower? We either have no rent growth or low rent growth in the projections, right? So these are all things that kind of talk about being a conservative deal. But being conservative really does give you more margin. And so again, when you look at experienced operators, they'll try to really build a lot of margin into deals so they can make sure that they're going to be able to perform on that. That's something we really try to make sure that we do at Broadstone Equity, especially with our partners, making sure that we're able to do that. We have the experience in that particular market to be able to perform on that. So anyway, to sum it up, be conservative, make a plan that works. Find a deal that works for you and has a margin of safety in it. Don't just think best case scenario, or if you do, hopefully there's a much higher upside to show. We've done some deals like this where they're just really higher upside. We have done something in the oil and gas space that's a more speculative type of deal, much higher upside, but there's more risk. So we're aware of that, right? But when you're talking about not losing money, buying real estate and other assets, you want to make sure that you're being consistent and not shooting for the moon on this. So I want to share this quote for you from Charlie Munger, who is Warren Buffett's partner. Again, I'm a big fan of Warren Buffett and Charlie Munger, so I'm going to share this for you. In engineering, people have a big margin of safety, but in the financial world, people don't give a damn about safety. They let it balloon and balloon and balloon. It's aided by false accounting. So, just again, the importance of a margin of safety. And that's why sometimes with projections from, in real estate from brokers, and if you're a real estate broker, no offense, but you just can't trust real estate brokers. They're going to give you legit numbers. It's going to be best case scenario. So you've got to really make sure that in your numbers, you're beating that up. You're looking at it from a really objective perspective. And as a passive investor, you're doing the same. You're looking, okay, well, if this doesn't work out the way we want, how is this? And is this person, this group being really conservative? So, I want to share this video with you. It's called Where is the Cash Flow in My Multifamily Deal? Or where's the cash flow in my real estate deal? Check it out here. Just talked about what's happening now with some higher finance costs and some higher costs where the cash flow may be eaten up, and just kind of what does that mean for real estate deals? And then if you haven't downloaded our ebook, How to Use Inflation to Your Advantage, you can check it out in the link below. Had really a lot of fun writing that, of ways to actually use inflation so that you can take advantage of it. And then we're doing this just this month. We're basically giving a $100 Amazon gift card. If you'll write a comment and you'll just put in there what's a topic that you want to hear about. If you want to hear more about this, you want to hear about macroeconomics or gold and silver, other things, stick that in the comment And then next month, we're gonna read one of those. We're gonna basically honor you on this channel and also give you a $100 Amazon gift card. So stick that below, it really help us out. Thanks for taking the time to educate yourself. Look forward to seeing you on the next video.